Hi, in our last video we mentioned trend resistance and support and trading in the channel. We used the line graph to do our analysis, and the line graph or any graph shows the price action. Sometimes we will see a pattern forming. Sometimes we will see a pattern forming on the graph, and we can use these patterns to trade as they provide us with high statistical probability of a certain outcome. So let's look at some patterns and how to trade them. Okay, here here we have the so-called head and shoulders pattern. So let me show you. So here we have the left shoulder, the right shoulder, and the head. They are called that way. Okay, so we have to do another line here. Should be parallel with the line we did. Okay, so uh, we have left and right shoulder, which should be the same length, the same height, and the head is higher. The head is higher. So when this pattern emerges, we wait for it to play out. We would enter into position only here, and we have to wait for the position for the pattern to end. And if it ends and breaks out from the neckline support, then it's highly probable it will go down. Uh, the the way you trade it is to place an order here, place an order around here, just below this previous bottom, and below the neckline, of course. And you would put stop loss somewhere around here, so just above the previous bottom and just around the neckline. For the profit target, we would measure the distance of the top of the head to the neckline, and we would copy it here. So this would be our take profit target. And as we see it here, it played out well. So if we were in this position, we would get a significant win here. Okay, so the next pattern I want to show you is actually just here, right here. Maybe I should expand it for you to see it better. Okay, so after the head and shoulders pattern, the market went down, and here it went into a consolidation in a triangle. So we see the triangle when the price is going up and down, but the channel is getting smaller and smaller. It's called price consolidation, and it usually means that there's gonna be a breakout. The breakout, in most cases, it will be in the same direction that the price entered the triangle. So here the price went down and the triangle was formed here. So we are expecting breakout on the downside, which happened. There are two ways to trade this actually. One way is to look at the leg, because this altogether would be a pennant pattern, a pennant pattern. Sorry. So you can trade the pennant like this. The pennant has a pole and has a flag. Let's say, yeah, pennant. Okay, so you would use the height of this leg, but we would, because it was a pattern here, we would use it like, let's say, from here, and we would use that pole for a take profit target. Okay, so on the breaker, but it didn't happen like that. But I don't suggest trading it that way, because triangles are traded differently, and I hate the flag and the pennant patterns because they are not that useful as the triangle. The triangle is much more common and it's used in a different way. It's used like this. See the top, sorry, see the, I'll just remove this, we don't really need this one, we needed something else. So the triangle, you take the top of the triangle and the bottom of the triangle, the two lines, and you'll measure the distance between these lines. Sorry, you'll measure the distance between these lines. And the breakout, when it happens, it should be the width of the beginning of the triangle. So here, if you were trading this, you would take some profit. You would enter into position around here, just below this previous bottom, if the price closes here, and you would trade the height of this triangle. So take profit would be here, and this trade would end in profit also. So this is the second part, the second pattern, and this is also one of the more common patterns. You'll see a lot of head and shoulders and a lot of triangles, maybe triangles even more, but head and shoulders are really nice to know because they give us a high probability of success. So the next pattern I wanted to show you is rounding top, or it can be rounding bottom. We have it here. I prepared it. Okay, so there's an upward movement here, and the upward movement loses momentum, and the price is trying to consolidate. It's going up and down, up and down, up and down, and this line acts as a support line. And when that line is broken here, we enter into position. So in this case, because it's going up, we would go in a sell, we would enter a sell order, because if the first leg is up, then the second leg is expected to be down, and vice versa. If it was down and this was on the bottom, we would expect it to go up. So we would enter into position when this support line is broken. So around here, if you have a situation like this, you see this bottom is a bit lower than others, but still, you know, it's not that far away. I would use it. I would use this bottom as my marker. So below this bottom, I would enter into sell position. The stop loss, I would put the stop loss just above this red line, because support, once broken, becomes resistance. So what we used as a support here now is becoming a resistance to this move. So how would we trade it? Yeah, we would wait for it to play out. We would enter into sell position around here. We would put stop loss there, and the profit target would be this distance. So the profit target would be around here, and it plays out well. Okay, so I wanted to show you a few more patterns. Let's see. Okay, here it is. This one is called the teacup pattern. So the market is going up, and then we have a bit of a reversal here. We have a bottom, and then we have smaller smaller reversals, smaller bounce, and the price is going up after that. So the price is going up, and here we have a bit of a consolidation move, and the price will go up. We can see clearly this looks like a cup, and this looks like a handle. That's why it's called the cup and handle pattern. How would we trade it? So when we see this pattern emerging, we would put the top around here. This would be our resistance. So we would have our resistance around here. Okay, this level doesn't matter really. We would trade it, we would enter in the position when the price goes above this top here, and it closes here, and we would enter this position here. We would enter the position here, put stop loss around here, and for take profit target we would use the distance from this line, from this resistance to the bottom of the cup. So here our price target would be here. This pattern is not that common, you will find it, but not as much as the previous patterns I mentioned. Okay, just wanted to show you one more pattern, but it's really an uncommon pattern, especially in the Forex market. It's more common on lower liquidity goods, maybe like stock, certain stock, or like we found it on some Bitcoin options or whatever this is. So here we have the island reversal pattern, and it basically goes like this. The market is going down, and it suddenly we have a gap in the market. So it was the price action. Sorry, let's show it like, no, we have to show it like this with the candlesticks because the line graph connects it all. So we will use this graph just to show you this pattern, and we will explain the candlesticks in the next video. So please just listen carefully just to show you this. So the market is going down, and it makes a gap and opens all the way down. It goes down, and we have a few candles going up, and this marks a reversal, potential reversal, and the market closes and it makes a gap and reopens here. So we would enter in a position around here. We would enter a position actually around here. Here is the gap. We'll use this gap as a marker. So this is called an island, and it's going down and it's reversing. So island reversal, and the position you would enter here. You would enter around here, and you would actually want to see a move like this. So yeah, let's show it like this. Yeah, so if you are trading this, the position to enter is around here. The position to enter is around here, but you would have to wait for the candle to close to have a confirmation, and you would want to take profit here. So this is the least common, and it's only inherent to some stocks, some options, not really on the Forex market. You will never see it on the Euro USD. If you see it, you will see it once in a lifetime because the market has too much liquidity to let this happen. Okay, I wanted just to mention this because this is one of the patterns that exists. Okay, so let's get back to some more patterns, and now I will talk about double bottom, triple bottom, or double top, triple top. So let's find something like that we could use. So basically, okay, just sorry, maybe there's so let's see, maybe there's a better example, but it doesn't have to be perfect because nothing is perfect in life. So let's find it somewhere. Okay, we can choose this. We can look at this. So basically, we will look at this here now. So the market goes up, makes a top, goes down a bit, makes another top, and the top comes close to that top, maybe almost even exactly, and it doesn't break it. It can't break it. And usually the market will go down. The market will go down because it can't break the previous top. But here we almost see a triple top. This top is just short of this red line. Uh, so it can also happen at the bottom. It just means a pattern reversal. Reversal is coming. There's no price target to be set here, but it is a reversal pattern. Also, uh, if I was using this pattern, and I use it a lot, but if I was using this pattern, I would like to get some more confirmation. I would definitely use the candlestick chart and the MACD. But I will explain all this in later videos. I just wanted to show you what exists. Okay, here is like a triple top 2. You see it. It's a common pattern. It's a common pattern, and what it basically means is that the price goes up to a certain level, resistance, and it can't break it, and it tries to break it again, it can't break it, and the third time it tries to break it, it can't break it, so the sellers take over the market. If the buyers cannot hold the momentum, usually there is a reversal, there will be a reversal in the market, and it's happening here. We'll talk more about these patterns when we learn the candlestick chart and when we learn to use some indicators that will give us better confirmation of what we are seeing. If we use only what we learned now, we have a statistical chance of winning some trades. Yes, we can actually make money with this, but the more we know, the higher the chances, the higher the probability, because this is a statistical game. Okay, this is all for now. I just wanted to show you the price action patterns because we are gonna use them there. It's useful to know. And in the next video, we're gonna focus on candlesticks, and I will try to explain the Elliott wave theory, which is also something I don't use, but I think it has some good ideas, something useful for anyone trading the forex market. Uh, okay, so this is all for now. Hope you're gonna join us next time. Bye.